rate hike from the Fed combined with the banking crisis means securing that loan is about to get even more difficult as policymakers continue to grapple with inflation, high inflation on top of that banking crisis. We turn to a local financial expert to break down what's next and who stands to gain following these changes. Darryl Rosen, a fiduciary financial advisor and CEO of Rose Advisory Group in Schaumburg. Good morning, Darryl.
Good morning.
Great to have you up. You're already makeup ready just before the market open. I suppose is probably par for the course for you, but we thank you for joining us. So the markets, moved a little bit yesterday, but let's go back. That this is now another interest rate hike just yesterday, the 10th in just over a year. What's this say?
Well, inflation is stubborn, and I think that policymakers probably underestimated the effect of all the stimulus, the effect of COVID, and this and the supply chain disruption and inflation. There's a jobs report that just came out this morning. Job market's still very strong, so I think that it's a conundrum for them. Do they because the markets want to see an easing of rates, and certainly people who are buying homes, people who are selling homes want to see an easing of rates. But even with this morning's report, I think these rates are going to be around for a while.
It is a conundrum. I like that word, a $5 word. I'd say a pickle, too. I mean, rising interest rates are meant to...
I was going to say that.
No.
I was going to say that.
We're on the same...
I vacillated between pickle and conundrum.
That's so great. All right, so seriously, though, rising interest rates are meant to curb inflation, which you said. But that's remained high for more than a year. So it's like these rate hikes aren't working, and that's, to me, the layperson. So how long are we going to be paying inflated prices for bacon, air travel, and on?
Well, if you're worried about the price of bacon, maybe you're eating too much bacon.
Yeah.
Could that be said?
True.
So
true.
Inflation is coming down a little bit. It's the year-over-year inflation numbers from 2022 to 2021, about 8% growth. That number has come down to about 5.81%. It is coming down, and you're correct to say that things like air travel, rent, eating out, those are categories that are still really getting hammered. I think the Fed, if they, at some point they're going to say, and I think they said yesterday words to the effect of, we're not going to be doing this forever, but it doesn't mean they're going to start reducing rates. So I mean, there's really winners and losers when it comes to this. I think, the winners are people who want to save money because those rates are high. The 7-day yield is almost 5%, and that's not tying up money in a CD for any period of time. You can move in and out. So that's really good. I think young people, Brad, are winners in a way too. I always talk to my sons about, when they buy their first homes to spend less money, to be more prudent. And higher inflation rates, higher interest rates are really make that a little bit easier.
Yeah, that's interesting, talking about the winners and losers. On the other hand, losers are anyone really looking to secure a loan, small business owners and home buyers. It's like a couple of years ago, loans were virtually free.
Right.
Now people are having a hard time getting them, even when they got 20% down on the note. How do you explain that?
Well, because there are ratios that mortgage companies use to determine what kind of mortgage you can apply for. It really depends on how. So they're going to take that payment, real estate, mortgage payment, real estate taxes, property insurance, that kind of thing. They're going to add all that together, and each bank, and it also depends on your credit. There's going to be a ratio that they're going to run. But when interest rates are higher, and I mean, if you just take a simple $300,000 mortgage or $300,000 home and you put 20% down, you're going to be paying almost $400 more a month than you would have been a year ago. So the ratio that they use, that's going to build that in there, and it's just it makes it more difficult for people to get loans. But also people who put money on credit cards. Brad, I have to tell you, I looked this up. The Banana Republic credit card. When they offer you a 10% discount to sign up for their card. The interest rate is 30%.
Wow.
I mean, it's outrageous. So I think that people need to be careful. I think that people who want to go vacation, we become very dependent on Airbnb and Vrbo and things like that. So these higher rates that people are paying to secure properties, it's going to reverberate and affect all of us.
Yeah, that's interesting and fascinating. I mean, 30% of the Banana Republic card, $400 extra a month on a $300,000 home on a 30-year note. That's fascinating. So let's say hypothetically you're one of these few savers out there. Obviously there's stock market volatility, earnings coming out every day. You don't know what's going to happen. You can't trust really. I mean, is this bank going to fail? Is it going to? So where would you park some extra money if you have it? CD percentage returns looking better than ever, kind of, right?
It's complicated because over time the stock market is the vehicle to outpace inflation. Mm-hmm. But where we sit right now with money market rates or CD rates in the 5% range, it's great for boomers. It's great for people who are retiring. So it really works out well. The problem with not being involved in the stock market is that if you look at the S&P 500, which is the gauge that most of us look at, there's only been 2 times in the last 50 years we've had negative years in a row. Mm-hmm. And that was back in the 70s and then during the dot-com stuff at the beginning of the century. So what prognosticators would say based upon statistics, and the S&P is up this year, that the S&P 500 or the stock market would be a good place to be. That's a hard one when you see CD rates and money market rates as high as possible. I will tell you this, Brad, and this is the advice that I give to all of my clients. We never take risks with money we need to pay our bills. So, right. And that is a lot easier now. So we should have money sitting in a money market covering a year's worth of bills, what have you, so that we're not dependent on what's happening in the stock market. Because you're right, it's volatile, it's up and down every day. This debt limit stuff is probably going to increase volatility over the next couple months. So you got to be careful.
Yeah, we're going to have you back on the debt limit. So what you're telling me is you'd probably advise your close to retirement age clients, hey, maybe park some cash in a CD, and you'd probably tell your sons, hey, ride this thing out, S&P, index funds, so on and so forth. Am I extrapolating?
Yeah. My sons are like, I have 3 boys, and 2 of them just are kind of the ride it out kind. The third one's a little more like, Dad, what do I do? What do I do? And so the young people can take advantage of something called dollar cost averaging. What dollar cost averaging means, and just sort of in lay terms, is that when you're lucky enough to stay invested and working in down markets, you can, and the market goes down, you continue to accumulate money in your 401k, but you're doing it at lower prices. Mm-hmm. You're essentially buying more stock or whatever with the same contribution. That's wonderful. So what happens as time goes on, for my sons, all in their 20s, it's what their money looks like 30 years from now, not tomorrow. And by virtue of the fact that they are contributing religiously when there's volatility in the market, they're gonna thank me for it later.
Yeah, I know they will, and we thank you for it. And an example of that is CBS took a dive yesterday. I'm in CBS stock, so now I'm looking forward to buying in at this cheaper price. With that, we have to let you go. Darryl Rosen, fiduciary financial advisor and CEO of Rose Advisory Group in Schaumburg. Thanks for being a friend of the stream. We're going to have you talk more in the future. Debt ceiling, we'll discuss other things. But have a great weekend. Happy Friday.
You too. Thank you.
All right. And you are watching this stream on CBS News Chicago. Coming up.